This strategy has continuously beaten the market and turned $10,000 into $1 million in just 17 years. And the best part is that it is easy to use and to maintain over the time. You just have to use the magic formula. And that's what the little book that beats the market talks about. And it has been by Joel Greenblatt, which is an ex-hedge fund manager that for more than a decade had a return of over 50% per year. And when he reached a net worth of more than 100 millions, he retired in order to manage his own money. And after his career in investing, he decided to write this book because he knows that investing is intimidating to most of the people, but at the same time it's extremely important for everyone's life because it is what builds security and wealth. And most importantly, he wrote this book for his own children, because he thought that if they knew how to make money, they would be able to do whatever they want in their life. And that's why this book is such a simple read with a lot of good information. And it actually is the book that I advise all my friends to read when they start to invest, because I really believe that this is the best strategy to invest your money, especially if you don't really know about investing. To develop the magic formula and so this strategy, Greenblatt started with 4 principles. And the first one is about what can you do with your money. So you have different options. So you can put it in a bank, you can put it under the mattress, you can lend it to a company, or you can invest in a company, which is by far the best choice. And most people don't know how to do that. And one of the reasons for which they don't know how to do that is that because it is extremely confusing. Because Mr. Market is crazy. And that's the second principle of Greenblatt. This because if you take any company in the world, you can see that in a short time they have enormous price fluctuations. For example, Apple over last year, the price has been a roller coaster. And there is a difference of 44% between the maximum and the minimum prices, but in reality the value of the company hasn't changed that much over this year. I mean, there haven't been particular events that changed the inner value of the company. Rather than that, this is just the madness of the market. Because the price is totally random. It can go up and down, because all of this is controlled by greed and fear. And because of that, you can't just predict what the price will do over the short term. And that's what makes extremely difficult to invest. But if you think about it, it means that you can actually have great discounts that can help you over the long term. For example, think that you want to buy a car that costs normally $20,000, but there is a discount that sells the car for half of the price. Would you buy it or not? I think that your answer is yes, because buying for half of the price, even if you want to sell the car, you have a margin of safety of 50% that can assure you that you will have a profit from that. However, how do you know if a company is at a discount? Because yes, it is easy for a car, you know which is the normal value of the car. But companies don't have a price tag. In the short term, the market value of the company is totally insane. But over the long term, the market value of the company has the tendency to go towards the real value of the company. And so, to evaluate the real value of a company, you have to evaluate the future earnings of the company, which is actually more kind of guessing rather than really evaluating them. And it's not easy at all, because imagine, you have a business that last year earned $1 million. So tell me now, how much will it earn over the next years? And so how much is valued the business? It's extremely complex, and my guess can be as good as yours. And that's why Greenblatt in his book, in the little book that beats the market, talks about 2 main metrics that have to be followed in order to understand which the value of the company might be. So imagine that you have one business, let's call it Nico, and another business, let's call it Fora. They both have a price tag of $1 million. But the first one, Nico, is earning $100,000 per year, whereas the second one is earning $50,000 per year. Which would you buy if you had to? It would clearly be better to buy the one earning more money. And that's what the price-earnings ratio means. Because in the first case, we would have a price-earning ratio of 10, whereas in the second one of 20. So the lower the price-earning is, the better, because it means that the company is more profitable at the same price. And so let's take again the example of Nico and Fora. But in this case, they are both earning $100,000 $10,000 per year. However, Nico just have costs of 10,000 per year, whereas Fora has a cost of 50,000 per year. Which business would you buy in this case? I think that you answered again, Nico, because to make the same profits, they spend less money. And that's what the return on asset is. And so the higher this is, the better it is for the company. It means that they are more profitable. And these two key metrics are extremely simple to understand and to use. And that's why Greenblatt in his book wants to use them to develop his strategy and his magic formula. And so what is now the magic formula, the strategy that has beaten the market for years and years? It's actually super simple, and this is why it is the magic formula. You just have to rank companies which have a low price to earning ratio and a high return on asset. And just doing that, Greenblatt has outperformed the market with an average return of 30.8% per year versus the Standard & Poor's, which has averaged only 12.3% per year over 17 years. And the incredible part is that this is still going on every year, every decade. You can see that the magic formula continues to work. Another interesting fact about this magic formula is that if you divide companies into groups according to the ranking, you can see that the first group is gonna beat the second one, the second one beat the third one, and the third one the fourth one, and so on. And that's really the proof of how this magic formula is actually working. And yes, I know that's a lot of theory, but actually how do you do it? How can you make this ranking? And here Greenblatt has been incredible, because he developed a website where you can see the ranking made by the magic formula all automatically, so you don't have to do nothing. And so at the end of the book, he provides the step-by-step guide to use the magic formula. And so step 1, go to magicformulainvesting.com. Secondly, choose the minimum size of the company in which you want to invest. What he advises is minimum $50 million of revenue per year. Then you see the ranking and you choose 5 to 7 companies in which you want to invest. And you repeat that process every 2-3 months with around 20% of your capital every time. This way, over 1 year, you have built your own portfolio. And another advice is to hold these investments for at least 1 year, because doing that, you will have tax advantages over capital gain. And so every year you can re-update your portfolio using this magic formula and this process in order to keep your portfolio updated or to add money to your portfolio. And that's how Greenblatt very simply created a system that he can share with his children, but he also decided to share with all of us. And so I really believe that this book, being extremely simple, it's clear, and it has a lot of learnings for every type of investor, from the beginner to the expert. This is a book that is a must read. I've read it actually a couple of years ago, and since then I've implemented this magic formula into my investments, and I use it mostly also to help me screen the stocks in which I want to invest. And yes, for the beginners, I think this is the best way to start investing by yourself, because it grants you diversification over your portfolio. And it is a way to do value investing, which is super simple and extremely profitable over the time. And so if you have already read this book, tell me what you think about it. And also, if you have any other book that you would advise for beginners, just write it down in the comments. Otherwise, if you want to discover about new books for investing, you can watch this video where I share with you the 5 books that I think are the best for starting to invest. So thank you for watching, and see you soon.